So the Fed just rug pulled the markets. The Fed came out and said, yeah, what you thought was going to happen is not what we planned to do. So what did they say? Well, let's go ahead and jump into this video. We're going to give you a rundown of everything you guys need to know. And first, let's start with the rug pull. So the Fed, okay, they have a summary of economic projections. It's literally what the title of it is the explanation. It's the summary of economic projections. So they project out GDP, unemployment, where the Fed funds rate's going to be, where inflation's going to be, and their personal opinions based off the data that they have gotten. Now, there's a summary of economic projections 4 times a year, every quarter. So what you got from this is 1 year Fed funds projection is at 4.6%. That means 1 year from now, by the end of 2024, the Fed thinks the federal funds rate will be 4.6%. So really that's in between 4.5% and 4.75%. Well, the previous SEP was a projection of 4.3%. So now they expect higher for longer. Same thing on a 2-year basis. That went from 3.1% to 3.4%, higher for longer. Now the terminal rate, that's where you really got rug pulled. The terminal rate is now expected to be 5.6%. The previous terminal rate was 5.1%. This whole time, everyone thought we were at the terminal rate. Nobody expected the terminal rate to go this much higher, but that it did. So that's really the rug pull here, is the terminal rate projection. This means that the Fed thinks they're going to have to raise rates 2 more times here in 2023. Longer term inflation, Fed funds rates expected to still be at 2.5%. Now, these are some of the bearish implications from the SEP. The bullish things for the economy is the GDP. In the March projection, they were expecting 0.4% for GDP by the end of 2023. Today, they're expecting 1% GDP growth for 2023. The unemployment rate at the March projection was 4.5%. Now they're expecting 4.1%. So better GDP, lower unemployment, soft landing. PCE inflation. March projection was 3.3%. Now it's at 3.2%. The core PCE, though, this one's strange. The March projection was 3.6%. The current projection is 3.9%. So a big jump on core PCE inflation expectations. This is likely why the Fed thinks they have to raise rates more, because core inflation just across the board, PCE, core PPI, core CPI, it's really not coming down. It's really just plateauing from here. So kind of weird things going on here. The Fed thinks a soft landing's more probable, but they think interest rates will have to go higher and stay higher for longer than what they previously thought. Now, this is what really caused the move today in the markets. Now, the move was down really quickly. It was back up, it was back down, and back up again. As you can see from the S&P 500, very volatile. But what's interesting is usually you get the biggest move from the actual press conference itself. Well, that did not happen this time around. Fed Powell literally gave us nothing besides saying the obvious, that he thinks there's no rate cuts coming for years down the line, which was interesting. But the press conference was more dovish than bearish, right? There was more things the markets liked out of the press conference rather than disliked. And Fed Jerome Powell wouldn't even call this a skip. So maybe it is a pause for sure. They really reiterated the data dependency that they need to take in their approach to fighting inflation. Now, a couple more data points that we're going to get throughout the rest of this week. But before we do that, I just want to say that this summary of economic projections was something, especially the terminal rate, that nobody expected. So really what this means, this higher for longer and now much higher for much longer, it means that some of your interest rate sensitive stocks, some of your big tech stocks probably need to come down, especially, I mean, considering the valuations are at almost the same levels that you were at when there was a zero Fed funds rate in 2021. Stocks have rallied a lot. This move today with the Fed is not very supportive of a rally from here. So I think you do have some pressure for any upside rally that's kind of now there that wasn't there, right? A lot of people are thinking we could go back to all-time highs. Well, that looks a lot less likely today. So there is some real downside pressure here on the markets based off of this summary of economic projections. Now, I'll continue to say this. Data is going to be the most important thing, as the Fed laid out as well. Depending how the data evolves, that's going to really, dictate how the markets trade. Now, especially earnings, this next earnings season now just got that much more important. Because if profits are better than expectations, then maybe the markets aren't as overvalued as we currently think they are. Because after all, when the Fed raises rates, that simple action should affect valuations for stocks. So we'll see ultimately what happens. Now, if we take a look at some of the data going ahead, tomorrow you're going to get retail sales month over month for May. You're expecting deflation at negative 0.1%. Last month's reading was 0.4%. So pretty bad retail sales we're expecting tomorrow. And the Fed, apparently they expect things like retail sales to be quite well with a 1% GDP increase for 2023. You're also going to get Philly Fed data, initial jobless claims, ECB press conference coming tomorrow, industrial production, manufacturing production, capacity utilization, business inventories. You're going to get a whole load of data coming in tomorrow at 8:30 in the morning. So I think the Fed today just really makes all of these data points that much more important, especially again, as they forecast to raise rates higher and to keep them higher for now way longer than what we were expecting. Now on Friday is probably going to be the next biggest catalyst, and that is the Michigan Consumer Sentiment Survey. You're expecting consumer sentiment overall to go to 60.8. Last month's reading was 59.2. So you're expecting Michigan consumer sentiment to get better. You really want to watch the 5-year inflation expectations, though, because these are at a really make it or break it moment. You are at a 10-year high for inflation expectations on a 5-year basis as far as consumers are concerned. If this does go higher, you're going to have a problem here. The last time that it really fell was during the crash in October, where 5-year inflation expectations went down to 2.4% or 2.7%. Now you've rallied to 3.1%. And if you break 3.4%, you're going to be at a 25-year high for 5-year inflation expectations. So you really want to watch this coming Friday. If you start to break out here, the Fed's going to be in a very big problem, essentially. You're also going to have 1-year inflation expectations. Those have been going higher as well, but not as concerning as the 5-year inflation expectations going higher, at least as far as the Fed is concerned. Now, like we said, just to round all of that off, stocks probably need to come down, right? Higher interest rates for longer, usually in simple economic terms, means stocks valuations get compressed. And you've seen multiple compression in 2022, but you've seen massive multiple expansion in 2023. The markets are basically saying the Fed has a credibility problem at this point. They're saying that the Fed is not going to follow through with their projections and what they think they need to do. So who knows when the markets are going to come to the realization that the Fed is going to do what they want to do. I think today was really a bold step by the Fed to signal 2 more rate increases. And you also had no dissenters. So dissenters basically are the Fed members. They all vote on whether to raise, hike, or pause. They all apparently voted to pause. Nobody voted to hike. Nobody voted to cut rates. They were all in unanimous agreement. We were waiting for some dissents. The last time that we seen a dissent from any Fed meeting was in 2005. It has been 17 years since you have seen a dissent from the Fed, and it did not happen this time around. But the dots are starting to kind of move, right? Not everyone is in the same kind of unanimous agreement on where interest rates need to go. More so for 2023, they're kind of in line with, 5%. One Fed official sees the Fed funds rate over 6%. Two see the Fed funds rate over 5.5%. Majority of them are right there at about 5.5%. Some are even as low as 5%. So some, see the rate by the end. Some still see cuts by the end of this year, but that's not the average expectation. And you could see the dot plot here. They're starting to really spread out, especially by 2025. A lot of people expect the funds rate to be 3.5%. Look at this dot up here. 5.5% by 2025 is what one Fed member is forecasting. A couple Fed members expecting 4.5% to 5%, a couple more around 4%, and then you get a bunch of the dots back here, and some are even expecting Fed funds rates at 2% by 2025. So you are starting to get a little bit of a wider range here, most certainly with Fed expectations, guys. So a couple things you want to watch out for. We just talked about the data as well. Tomorrow's data is going to be important with retail sales. How this all affects AMC. Again, stocks need to come down. That puts pressure on hedge funds. If AMC can have a bullish catalyst or a reason to rally, I think that's just going to make AMC rally even more. Now, in theory here, higher interest rates for longer and better economic activity should be a positive thing for consumer staples, stocks that really revolve around the economy doing well, like a Walmart or something. They're not as affected by interest rates going higher. But if people stop spending money, if GDP goes negative or goes into recession, they're hit very hard. So you should have seen a reaction in consumer staples to the positive and a negative reaction in tech. Quite the opposite happened today. So watch to see if that does start to play out. Now, if we take a look at AMC specifically, cost to borrow fees are still rocketing higher. Cost to borrow average 266%. Cost to borrow max at almost 300%. Cost to borrow minimum sitting at about 10%. Live short interest or free float at 23.37%. And 120.66 million shares that are currently sold short. Interactive brokers short availability, 65,000 shares that are currently available with a cost of borrow fee of 108%. So some very high numbers that you are still seeing with the cost of borrow fees. Positive order value of 0% on the day. You've seen 11 orders totaling $1.23 million. Now, for AMC specifically, the Fed today was not really a positive catalyst whatsoever. AMC tends to be an interest rate sensitive company. They're going to need to raise rates or need to raise capital at some point in the future. But at the same time, they are sensitive to the economics of the economy, right? If people are losing their jobs, if unemployment goes higher, it's not going to be a good thing for movie theater companies. So it's kind of a mixed bag here as far as direct implications for AMC. Overall, stock was down 2% today, up 0.21% in after hours. Again, you are in an uptrend for AMC, and I think until you get either positive news or negative news, this uptrend probably going to continue to the upside, as you did see even the MACD cross into bullish territory, and you have seen a flattening out of the RSI, guys. So, as you know, we do have a large option expiration by this Friday. You have hundreds of thousands of options at specifically that $5 strike. If AMC can break above $5 per share, which is what, 8 cents away right now, that's going to be a positive thing. So you still do have a chance for a bit of a gamma squeeze here. We'll have to see, how the markets react to the Fed today, how economists and analysts kind of think about this, right? That's what's going to move the markets from here, is how do people digest this new information. Bitcoin, though, down about $1,000 after the Fed meeting. Nothing too crazy. Bond yields slightly higher, as they should be, because higher interest rates should lead bond yields to go higher. And the dollar did, come down by quite a bit as well. So that is going to do it here in this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.